Okay, welcome everyone. Jason here again from Alliance Corp Property Experts. Got another great video for you. This is a quick one on lender's mortgage insurance. So obviously when you're looking to buy a property, there's a lot of costs to consider. You've got deposits, you've got stamp duties, but you've also got lender's mortgage insurance. Now, is this a worthwhile investment? Can lenders in mortgage insurance actually work for you instead of working for the banks? Well, let's have a closer look. Friend or foe? So what is LMI? Well, if you jump online and look up the definition, you'll find that lender's mortgage insurance is actually there to protect the banks, not you. So banks, when lending you money, will happily lend you up to 80% without lender's mortgage insurance, but that means you've got to put in a 20% deposit. If you want to put in a smaller deposit and lend above 80%, well, the bank is taking on added risk because you're putting in less money into that property. So the lender's mortgage insurance will cover them in the event that you have to sell the property. Maybe you sold it for less than you purchased it for. The bank wants to make sure that they get all of their loan that they've lent you back. So it protects the banks, it doesn't protect you. Now, it's also very expensive. On a $500,000 loan, if that represented 85% of the value of the property, they charge you 1%, which is $5,000. If the 500 represented 90%, that's 2%, but $10,000. And at 95%, you're looking at 3%, approximately $15,000. So that's a big contribution towards the purchase. You've got to pay it at settlement. So a lot of people think, looking at this, would think, oh, you know, that's just crazy. You know, that sucks. Why do I have to spend so much to do a 90% lend? Look, I can tell you now, that's the wrong way of looking at it. As an investor, you're trying to invest a little amount of your own money into these properties as possible. The more money that you can hold back, the more money that you'll have to cover cash flows and buy the properties, etc. So lender's mortgage insurance is one of the best strategies ever for investors because it would make it so hard for you to build property portfolios without it. So let's have a closer look at some of the reasons as to why this can be one of the best investments you can make. All right, so let's have a look at this scenario. Let's say you had $100,000. Now, it could be cash or it could be equity that you've pulled from a property. That $100,000, if you wanted to buy property and avoid lender's mortgage insurance, you need a 20% deposit, which is quite significant. In this example, you need $80,000. On top of the $80,000, you'll have some additional costs, stamp duties, etc., of say $20,000. So that effectively is $100,000 that you would need to buy a $400,000 property. Now you might be saying, well, I've got that, so that's great, and now I don't have to pay lender's mortgage insurance, so that's what I'm going to do. As an investor, I would say that number one, that's risky, and number two, you're not leveraging. As an investor, you want to put in a little amount of your own money as possible. The less money you put in, the more money you have left over. And why is that important? If I buy this investment property and, for example, I have a situation where the tenants move out and I'm between tenants, or I have some unexpected costs or a hot water service blows or something, I've got to pay for that. But if I put all my money into this property, money might be tight for me at the moment to come up with those funds. I want to buy this in property and have insurance for myself. So what I would do is I would do a 90% lend on this purchase. Therefore, I only need a $40,000 deposit plus my $20,000 costs, and then I'd pay some lender's mortgage insurance, which would be $8,000. So now I only need $68,000 instead of the $100,000. That $68,000 leaves me another $32,000. That $32,000 is my insurance policy. It's my buffer. It covers all incidental costs, etc. But it can be also used to buy other properties. Now, other advantages too is that for a $400,000 purchase, it's not going to get you into the best areas or the best type of property. Sometimes you need to spend a little bit more. But because I've done lender's mortgage insurance, it means I can increase my purchase price provided the bank's, my borrowing capacity is quite strong. So I might want to spend $450 or closer to $5, and it'll get me a nicer property in a nicer area, but for the same amount of cash. So lender's mortgage insurance is just how you look at it, guys. Yes, technically, it's an insurance there for the banks, but you can also use it to your advantage when you're buying investment properties. It protects your cash flows, it can get you into better areas or increase your purchase price. You can buy more properties sooner because effectively you've got $32,000, which is half the deposit you would require to then get your second one. So get into your second one quicker, and it's tax deductible, guys. So absolutely every day of the week, LMI is one of the best strategies because without it, it would take us forever to build investment portfolios because every time we've got to find 20%. It just takes too long. Okay guys, here's another example. LMI equals leverage. I touched on this before, so important. Let's look at a very high level example. Let's say you've got $100,000 like we talked about, and you thought to yourself, look, I don't want to pay LMI that 100K gets you a $500,000 investment property, yeah? Because you've got to pay 20% deposit, which in this example is $100,000. An investor, however, says that's crazy. You know, I want to grow a portfolio, I want to build wealth, I want to leverage, I want to maximize my returns. I'll go to the banks, I'll take out LMI. This means I only need $50,000 deposits to buy a $500,000 property at 90%. I can get two. So now I've got two investment properties for the same 100K investment. Yes, it cost me $10,000 each in LMI, but I only pay it once. But now I've got two properties growing in value. So if you have a look at a return, let's say for example the returns were 10%. This person here's got one property, 10% return gives him $50,000. It's a 50% return on their initial investment of $100,000. The investor says, I'm not interested in that. I'll go out and get two properties with LMI and I'll get $50K on each of those, giving them $100,000. $100,000 return on $100,000 initial investment, that's 100% return. So every day of the week as an investor, wouldn't you want 100% return on your money rather than a 50% return? All right, that is the power of leverage. The other thing to consider too, get you into the market a lot quicker. So some of you that might be sitting there trying to work out how long it's going to take you to get that 20% deposit, it could take you another year or two. And by that stage, the property market's increased in value over and above what it took you to be able to save up that deposit. You're actually going backwards. You saved up another 50, the market jumped up another 70 or 80, all right? You actually went backwards. So it allows you to get into the market sooner. Now, some of you might be home buyers and going, is LMI a good thing? Well, my response to you is it depends on the market. If you're buying in an area that's increasing in value quite quickly, as I said before, you just need to get in. So sometimes it's better to bite the bullet and pay the LMI, but get into the market sooner on a smaller deposit. However, if you're in a market where it's quite flat and we don't see some capital growth for quite an extended period, well, maybe you don't need to jump in just yet. Keep saving, because the more you save, the less you can reduce that LMI. So it just really depends on your circumstances in terms of how much you can save and how quickly, and also what the market's doing. Do you need LMI all the time? No. If you've got heaps of cash and heaps of equity, which sometimes happens when we're dealing with people that are closer to retirement, they don't need to do 90% lends. They've got that much cash or equity, we can buy them quite a few properties still at 80%. All right, so it depends on the circumstances. So my point is, guys, LMI is your friend. All right, absolutely use it as an insurance policy. Put less money in, have money left over to manage cash flows, but also get into that next property sooner. So absolutely, it would take us way too long to build big portfolios if every time we had to come up with 20%. It would just be impossible to build these big portfolios. So if you want to learn more about LMI and finance and loan structures, really important you learn this stuff as an investor. Download the ebook that I've got on the screen now. That's 6 Essential Principles for Financing Your Portfolio. It's a great ebook. I've got plenty more on our website, plenty more videos. I hope you enjoyed this video. Guys, keep learning. All right, the more you learn, the more you earn, as they say. Thank you.